Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is Danielle DiMartino Booth, founder at Quill Intelligence and former Dallas Fed advisor. Thanks for joining us, Danielle.
It's great to be here in this most wonderful time of the world.
It's a pleasure.
So, Danielle, we love having you on. Thanks for joining us again. We've got an exciting news week coming up. The Fed has their meeting on Wednesday. Tomorrow, this video will be out on Tuesday, hopefully. And it's really, you were telling us it's really unusual. What is so unusual about this week that you're especially watching?
Well, in an era in which everything seems to be being canceled, it's long-standing tradition that the Fed not come in and cancel Christmas. So that's a big no-no. It's a tradition within the institution that you don't do anything to adjust policy right before the holidays. And so the Fed has typically been hands off. There have been exceptions. I don't know, when Janet Yellen raised interest rates right after Trump got elected. So there have definitely been exceptions of the political sort, but it is unusual to see what I think we're going to see on Wednesday. I don't know, but I think at a minimum we'll see an announcement that your New Year's present is a double taper. So we'll move from 15 to $30 billion in reduced purchases in January so that the Fed can expedite the process and be out of tapering and potentially into raising interest rates before June 30th, I think is kind of the internal goal. They're in a really bad place though to be doing this.
If they reduced it by 15 this first month, they're at 105 now. At 30 billion a month, that's like March, right? That's like March, April. They're done. They're no longer buying bonds. They're out of the mortgage market. They're out of the treasury market, right? That's a huge change when the biggest buyer in the market is no longer buying, right?
I want to say that it's pennies, but it's not. And it should be pennies. And that's what the problem with markets that become overly dependent on the Fed, or to quote Jay Powell circa October 2012, that quantitative easing could be habit forming in his words. Wasn't he prescient? Bless his little heart. He'd only been on the committee for like 3 months, so he did not dissent against QE3 at the time. But in this short span that we've seen reduced purchases, we've seen some highly unusual behavior in between the TLT, hashtag $TLT, which is like the 20-year Treasury plus maturity ETF, and that of Treasury inflation protected securities. We've seen the spread between those two gap out as if the Fed had pulled back by a magnitude of 2 or 3 or 4 times that 15 billion for the 1 month. We've seen the spread between the 30-year Treasury and the 30-year mortgage rate spike as if, again, the Fed had been doing a lot more than just taking $5 billion of purchases out of that market. And in fact, this is fresh research. I haven't talked about this publicly yet. So what we're seeing is that there's already a reaction just with that 15. So let's see what 30 does. Let's see what that multiple of 30 does. And then let's look at what the yield curve is doing. And you tell me if the Fed can ever hike interest rates. Will the Fed hike interest rates? This is my biggest, I'm going to do a Twitter poll today. Can the Fed raise interest rates if the yield curve is inverted? Because that is the question.
Well, what the yield, just tell our audience, I already know, but a yield curve inverting is a sign of a coming recession, correct? Yeah.
So if it persists in its inversion for a 90-day period, that has typically been a signpost of entering recession. The reason not QE was launched in 2019 was specifically because the yield curve had been inverted for 90 days. So the Fed rode in and literally bought up the short end of the curve to uninvert it. They forcibly uninverted the curve. They're going in the opposite direction this time, though.
Yeah.
And that's what people don't realize. They're not going to launch not QE when they're trying to get out of QE. So it's, again, this is, I'm going to show my age here, but this is like Ghostbuster stuff. This is like crossing the streams at the same time that dogs and cats are living together. All of the cliches that you can think of is the Fed trying to get in front of this massive error that they've made by not tightening sooner.
Yeah, so it's obvious that everyone talks about it. The Fed is trapped. They can't raise rates. There's too much debt. And it's like, what are they going to do? Are they going to blow up the market, blow up the housing market? I mean,
are they going to put a recession? Are they going to make a recession a worse recession? I mean, that's kind of against the rules.
The last time inflation was this high the most recent inflation number was 6.8, 6.7? I think it was 6.8. Was 1982.
Yeah.
And at that point in time, when was the Fed funds was what short-term interest rates were way higher in order to stop that inflation, 8, 9, 10%. And
that would be nice. Can you imagine? We'd all go to the bank and get a CD.
Yeah.
For your viewers on YouTube, it's called a certificate of deposit. Ask your great grandparents about it.
Well, all those people who had bonds and CDs at 15, 20%, back in the early 80s.
And that's the thing, right? And what you're describing is the ultimate quandary, because if I'm Joe Q Pension Fund, or I'm Joe Q Me, or I'm Joe Q anybody, I should be calling myself Jane, hello. But anybody would hit that bid. The whole world would be in cash if it was an 8 or 9% overnight rate, and you'd have nobody in equities.
Yeah, or the housing market, or a lot of selling would be, a lot of people would be defaulting, I think, in that scenario. But one of the things, you just had a great tweet this morning that I wanted to bring up. You seem to have something for, well, let's go to Paul Krugman first, because he had the tweet before your tweet. Paul Krugman, Nobel Prize economist, winning economist, but a very political guy, had this statement recently. Is there any good reason to believe that inflation hits low-income households especially hard? And what's your first take on that?
Yeah, I mean, let me get back to you too on that one, because I don't know where to put it in my brain. I mean, there's no like file up there for like, this isn't like, Keynes versus von Mises. This isn't like, let's debate. It's not true. So I'm not like, I don't know where to put it. But it's not true. It's, I'm going to go back to my business law days in business school. There's something called prima facie evidence. And that's when something is evident on its face. So if I'm a millionaire, I'm spending it. Actually, I can send Paul Krugman, the Bureau of Labor Statistics, link if you'd like to look at the actual data. So if you're in the, if you're in the bottom 10%, then you're spending upwards of 45% of your income, disposable income, on housing. And if you're in the top quintile, you're spending like 10% on housing. So I think inflation is a regressive taxes kind of prima facie. It's a prima facie statement. It's evident on its face. So I don't really know where he's coming from.
Well, there seems to have been, this is an article recently on CNN Business. There seems to be a media push to try to convince a lot of people that inflation is bad for rich people and not necessarily, I don't know, good for people at the lower income levels. It seems, I've seen this I've seen it on Forbes, I've seen it on CNN Business, I've seen people talk about it on Twitter, and I just don't get it. Is this an organized push to try to change?
I heard a rumor that the media is liberal, so don't tell anybody, please.
Yeah, okay. No, we can't say that, right?
Because Bloomberg, which is going off the rails liberal, which they recently got rid of me as a commentator, which is fine. I'm no harm, no foul. What I could submit to editorial after Biden got elected seemed to always be, even if it was just factual, seemed to be questionable. Anyways, I digress. But Bloomberg just ran a story that corporate profits are at 50-year highs. So I gotta say, if the angle is it's going to pump up wage inflation, corporate America would beg to differ. So let me know. I'll get back to you on that too, because they're automating faster than you can say, Flippy, who makes French fries. It's an automated, machine, or the kiosk in the front of the White Castle, or his buddy who's flipping burgers, but they're all machines. So corporate America is not going to just be like, it's for the public good, and we don't have shareholders, so we're just going to pay up. Look, our minimum wage is too low. There are reasons that people are out of the workforce. There are reasons that there is what we used to call food stamp. Now it's supplemental nutrition assistance program, that there's rampant SNAP debit card fraud because stimulus has gone off the rails. So there are reasons that people are choosing to stay out of the workforce. I heard this when I was in Austin last week. You got $8,000 sitting on some SNAP card, but the last thing you want is more food, because they had a 32% increase roll out on October the 1st. And it was announced the day that Biden accidentally, pulled out from Afghanistan way too quickly. So they immediately rolled out this executive order food assistance program that had been executive ordered in January of this year.
Really?
So the day they pull out of Kabul, the USDA, the U.S. Department of Agriculture, announces that this food stamp program, effectively, what we used to call food stamps, is going to increase by 32%. The biggest increase in the history of the program.
Wow.
Wow is right. So we'd already put so many people in the SNAP program post-pandemic that we'd gone from like $190 per household per month, all the way up to $430 per household per month as of August. And that was the base upon which a 33% increase was coming. So, lower income households are like, what am I going to do with all this stimulus money? Because I don't want groceries. I want other things.
Well,
don't they know that there's a Gucci store? So they find a relative who's, I'm being obnoxious, but I'm not, because there's a lot of aspirational buying that goes above and beyond what we would expect from the top 1%. You can only own so many Hermes bags. Anyway, so you find a liquid relative, you sell them your $8,000 debit card balance, and they're anonymous, these cards, they can be interchanged. And then you ask for 50 cents on the dollar. You got $4,000 in cash, but your relative who's got $8,000 is like, hell with the filet mignon. We're going to have, king crab and Wagyu beef. And we wonder why beef prices are up 22% year over year. This is a stimulus created form of inflation.
Yeah.
Well, I recently Kellogg announced across the board in January, they're raising their prices almost 20%. For almost all their products.
Because the lowest income and the highest income can afford it. The middle just keeps shrinking and shrinking and shrinking and shrinking. If you're not on these food assistance programs, if you're, there are 61 million children, there are 73 million children in America. There were as of 2019, 61 million are getting the child tax credit in cash. 90% of US households with children are getting the child tax credit in cash every single month. And Joe Manchin, has the chutzpah to say, you know what, we need to stop and re-examine what the stimulus is doing. And we need to see how logical it is. Maybe it's too much. Maybe it's actually causing people to stay out of the workforce. Let's do a stop and rethink. But if you think about, $550 from the food stamp SNAP program and $550 on average from the child tax credit, and you put that together to get $1,100, that's enough to keep one spouse, $1,100 of income a month in cash. That's enough to keep one spouse out of the workforce and continue to stick it to small businesses. Sorry, I went off on a tangent. I didn't mean that.
No, it's totally relevant. And what
but the devil's in the details here.
Yeah. If one spouse is, of course, staying out of the workforce, then they might choose to pull their kid, young children out of daycare and just save that money too. It just changes the math of, for some of these families, not every family, obviously, but some families it does.
Well, it changes it for enough because we've seen inflation crop up in all kinds of weird places that you would say, this is not a supply chain disruption.
Yeah, used cars is a big one. And I saw something that all the used car inflation we've seen the past 2 months, 13.5%, I think is the figure off the top of my head. That trickles into CPI in December and January. Isn't there some sort of lag delay, right?
There is indeed.
Yeah.
And we've actually seen a slight turning in used car prices. And I'm going to do a tiny bit of pushback because I've been getting more photographs and more evidence of lots and lots filled with cars that are literally lacking one semiconductor chip.
Wow.
So, and we've seen that the pool of potential car buyers has pretty much been depleted.
Yeah.
So what's going to happen when the next time we meet in the new year, we're talking about, wow, car inventories just went through the roof. I mean, what happens when that narrative shifts and yet food inflation's still off the rails, which is what we call an essential, because you're talking about used car inflation and new car inflation. That's a discretionary purchase. But if middle income earners are still being squeezed by essentials going up, the New York Fed just came out today and people are anticipating that rents for apartments are going to rise 10% in the next 12 months. These are unprecedented numbers. And I thought 2020 was the year of hashtag unprecedented. 2021's making 2020 look like a walk in the park.
Yeah, 2022. I'm looking forward to it. Should be exciting. Hey, you just talked about owner's equivalent rent, and there was another, famous guy, a lot of people familiar with, Bill Ackman. The recent CPI number that came out last week, obviously it showed only 3.5% year over year. The housing number, which is a huge portion, what is it, 30-40% of the inflation CPI calculation is this 3.5% number. But that's really not telling the story of what's going out there in the real world in terms of rental increases, housing increases. Could you walk us through this real quick for the audience and explain what Bill's talking about here?
So to Bill's point, how the Bureau of Labor Statistics has a pool of homes that every 6 months or so, they go in and check the prices in this rotating pool of homes. And if they see there's an outlier, they're like, why is that home price so high? They're like, well, that's a statistically insignificant point. So they throw out the high home price home. It just gets booted out of the pool. Well, that's convenient.
Yeah.
And the gauge is supposed to be based on imputed rent, what you could possibly get for your home if you rented it. I mean, that's a really nebulous construct, but OER is designed to never. Some people say that there's going to be a lagged effect and it's going to come in like with a 5-quarter lag, and Freddie Mac has done some good work on this. It's not that we're not going to see higher owner's equivalent rent, but we will never see a full reflection of what people are paying in OER because it's systematically designed to kick out super high prices.
Yeah.
So it's the most messed up thing you could ever, that I didn't really even want to use the word messed up, but anyways, I did. I was polite, but it's the most messed up construct you could possibly ever envision.
Yeah.
And I think Bill sent out a subsequent tweet that noted that single family rentals, and this is a once cottage industry that's exploded. When they sign a new lease, they're getting 17% year over year increases when new people, there it is right there. Yep. Invitation Homes, their most recent print was 19%, and the shareholders love it. And Wall Street has really done a great job of propping up this industry with as much capital as you can possibly throw at it, but it's doing a lot of nothing for the middle income earner.
Well, if the Bureau of Labor Statistics was using these more accurate numbers for what real people are paying out there for rentals, current CPI, core CPI, removing energy and food would be not the 4.9% they reported this week. It would be 9%.
Wow.
And that 4.9% was a 30-year high.
Yeah. And this is also the highest in 30 years. The highest this century was the official 6.8%. If they had used a real one, imagine the shock. And here's why, of course, they use their owner's equivalent rent new calculation. Imagine the shock if we hit double digits in inflation. This is why they do it, isn't it? I mean, people would be flipping out if they saw 10%.
Well, guess what? Joe Manchin's on Twitter, so maybe he's flipping out. Again, I don't think people quite appreciate how important 2022 is because of the midterm elections and because we have a few moderate Democrats who are pushing back against so many of these stimulus measures that have created unintended consequences. And on top of that, I'm going to go back to my child tax credit that I hope is not edited out. That there are millions of American families who are anticipating, it's either the down payment for their car, it's how they pay their credit card debt from Christmas, it's how they save up for the coming vacation. But millions of Americans get a big tax refund in late January, early February, and that's huge cash for them. Well, the child tax credit being paid out as cash means that they're not going to have that credit to take, and they're not getting the refund that they think they're going to get.
Yeah.
So this tax season, in addition to the Fed trying to tighten into an inverting yield curve, I mean, I'm not trying to do scare tactics. I'm just trying to say that inside of Q1, we could be talking about recession.
Yeah, I believe it. Hey, you also have a YouTube channel, and you were telling me about something you just recorded with Lacey Hunt. Could you tell us about that and what to look forward to on your own YouTube channel?
I just recorded 6 episodes in Austin, Texas last week. Christopher Cole, Artemis Capital, the king of volatility. His was epic, but 90 minutes I sat down with Lacey Hunt, 90 solid minutes, and it felt like 5 minutes. And the people, it went from just being the film crew to the people in the Artemis Capital's offices that they joined in. They let us film there on the 32nd floor. It's phenomenal view, beautiful view of downtown Austin. But the time we finished at 90 minutes, you could have heard a pin drop in the room, and then it was this spontaneous eruption of applause.
Wow.
So we're going to get that. We're going to rush it through editing because it was that good. So hopefully it'll be up on my YouTube channel, Danielle DiMartino Booth, YouTube, just Google it and subscribe if you haven't. And that will come up, and it's going to be,
in the next week or so. When should I look for it? In the next week?
Probably in the next 2 weeks. I mean, I can't,
Okay.
it's a long, but you'll know it when it's there. Maybe we'll say Happy New Year's with that. But I mean, we started out with the 1913 Federal Reserve Act and methodically made our way through all of the mistakes that were made subsequent to that. So it's the best work I've ever done.
Oh, well, when you tweet it out, I'll be sure to retweet it for our audience.
Yes, absolutely. They'll enjoy it.
Danielle, thank you very much for joining us. We really appreciate it. And we look forward to talking to you. Maybe we'll talk in, it's December now, so maybe February or early March, we'll get together and review the first quarter.
We'll put up a chart of the yield curve.
Yeah.
Time comes. Happy holidays. Happy New Year's to all your viewers.
Thank you very much.